Hi, this is Peter Wilcox, investment advisor at Affinity Investment Group, and I'm here today with managing member Greg Gagne. One of the things we come across with a lot of our retired couples that we speak with is something that Greg refers to as the widow tax trap. And this is actually a planning dilemma that these people don't even see coming. Greg, could you expound on that a little bit for us?
Sure thing, Pete. I'd be happy to. In our experience, yes, we've encountered this thing we call the widow tax trap, and I'll explain it in this video segment here today. For most folks, the average couple, when they retire, things are going pretty well. And what we mean by that is typically they have decent cash flow coming in, and in many cases, not at every case, but in many cases, they don't have any debt to speak of. They've paid that down along the way. And as a result of that, they have an IRA portfolio, a retirement account, if you will, that they think about taking dollars out of. But if they do so, something happens, it's a taxable event. So more often than not, these people will delay taking money out of their retirement account until they're forced into the issue at 70 and a half years old via the required minimum distribution rules. But let's fast forward, if we will, to find out what that actually is going to mean down the line for the uninformed. See, when these folks become 80 or 85 years old, something's going to happen. And what I mean by that is somebody's either going to die, become disabled, or hopefully nothing is going to happen. We'll talk about death planning first in today's segment. What happens is the next year, our widow or widower, I'll say widow for this example, does the tax planning, but now as a single individual. And the way our tax brackets work in our country is the married couple who is filing a joint return has a bandwidth tax-wise twice as great as the single individual. And what this all translates into, in more cases than not, is that the widow jumps tax brackets. She goes from the 15 into the 25% federal income tax bracket, and then all too often gets to get a double kicker because she'll now pay taxes on 85% of her reduced Social Security benefit, because as you may know, we can't keep both benefits. When somebody passes away, we only get to have the survivor benefit. So she pays taxes on 85% of her reduced Social Security benefit at the 25% federal income tax bracket for the rest of her life. And that is something we call the widow tax trap. And you see, it doesn't need to be that way. There are planning opportunities that if we do advanced planning could mitigate, if not eliminate, that possibility from occurring in someone's life. If you'd like to learn how those planning techniques may be available to you, please feel free to email us or contact us at the office at 1-877-858-8156, and we'd be happy to set up a consultation to discuss. Thank you very much, and make it a great day.